Do not chase this rally. Unless, of course, you think that Jerome Powell is going to give us a surprise rate cut on the FOMC announcement this Wednesday, which there may be higher odds of than you think, but we'll talk about that later. The truth is that the S&P 500 is running straight into technical resistance after good news, and it may need to cool off here. Even Jeff Bezos can see it and plans to sell $4.8 billion worth of stock. That's billion with a B. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY monthly time frame chart now that the April bars have officially closed out. And as we've acknowledged on Wednesday's midweek market update, this is a hammer candle for the ages. The lower wick alone represents 15% worth of range in the S&P 500, both down and up. And most importantly, the call out I would really reinforce is the fact that April closed back inside of the March range, which could be considered 2 ways. Number 1, really strong buyers stepped up down here towards the lows, or the sellers simply didn't have enough conviction to battle for price acceptance down towards the lows. Either way, it's a bullish indication. And as you can see, what's already developing in the month of May, it's only 2 trading days in, we're testing the April high. And therefore, it seems very plausible that the May bar-to-bar count can yield some sort of higher high and some sort of higher low. So bullish there. If we consider the location of the lower wick of the bar, we also know, and we've been reinforcing, that it's a very precise hold of previous resistance acting as newfound support. It's happening over an upward sloping 50 SMA, and its confluence with our support trend line here. The only bearish argument that I'm seeing online that's circulating is that this hammer candle might be similar to what we experienced in the dot-com bubble bursting, like what we had back over here. And I would argue that it's actually not a fair comparison. In the dot-com bubble bursting, the monthly trend had already neutralized via some sort of double top here, and I would take it one step further and just say, okay, when and if we took out, in the current case, the hammer candle's low, that's where painful moment number 1 and painful moment number 2 come from. It does not happen until you actually take out this candle's low. It doesn't mean that we can't develop into something that looks similar to this, but as of right now, not even close to a fair comparison. You can see a similar story here in the Great Financial Crisis, where if this is similar to the candle that we're dealing with, it's not, the range is not nearly as large, it would still indicate that things don't really turn sideways or down until we get underneath the low of the hammer candle. Notice here, once again, that we do produce a double top, and then when there is a monthly lower high near the hammer low, when we break that, that is where things get really ugly in the Great Financial Crisis. Even if you wanted to model this as the current circumstance, it would suggest that we have at least 2 more months to come up and make an equal high on the monthly time frame. So if we just go back into our current monthly view, this would have to play out as perhaps, if you're going to make the comparison, right, a double top as follows, and if things are really going to get nasty, some sort of lower high on the monthly underneath something like 480. I'm not seeing that in the cards in the near term based on the higher time frames. This is something that would have to play out over the span of months, probably into the end of 2025. We'll take that one step at a time, but for now, definitely still bullish on the higher time frames. Let's take a look at the weekly time frame chart. Let's get a little bit more granular here, and let's get into our usual process. Candle structure and location. What do we see? We've got ourselves a solid green-bodied bar with a meaningful lower wick. The reason I call it meaningful is because of its location. If we recall the threat for the weekly lower high, it was that previous support could act as newfound resistance, and the lower wick of this weekly bar technically tests underneath that key area. However, we can clearly see that the buyers responded, and there was a very strong close towards the highs of the weekly range. That is inherently bullish. It's a great segue into location, where we can also say that on the bar-to-bar count, we do have a higher low as well as a higher high. You can see that we've closed right at the weekly 50 SMA, the blue moving average on the screen now. So structure and location both go to the bulls, and recall that the trend count here is very close to neutralizing. We have highs, we have lower highs, and it would be reasonable that an equal high here could neutralize the weekly trend. It's also possible, and we've been talking about this, that a weekly high or low could really happen anywhere. Ideally, it's here as we walk forward over 550, but a weekly high or low could happen anywhere over 520. at this point. I would start to read into the idea that the daily and weekly higher low happening here are almost one and the same in the trend count, although the daily trend never officially flipped to down in that particular region. It neutralized, but it never really flipped to down. So it's a soft weekly higher low there. Generally speaking, though, a lot of bullish things are taking place here from a Fibonacci retracement perspective. If we come in from the all-time high to the lowest low of the move, notice that the weekly bar has closed now over the 61.8 retracement, which would increase the odds that over time, a 100% retracement ultimately does take place. You could no longer say that this is reasonable bear flag consolidation because we're clearly well above the Fib 38.2. Even if we come in from the last lower high to the lowest low, this one should really speak for itself, we're now using the 61.8 as support instead of staying underneath it in no man's land down here. This is a constructive move and once again supports more of a bullish outlook here on the weekly time frame in my estimation. If we take a look at the anchored VWAPs on the weekly time scale, I just want to zoom out so you can see where this anchor is coming from. All of this is happening over the upward sloping anchored VWAP from the 2022 low. You can see that we've recaptured these two from this monthly pullback towards the end of 2023, and we're parked right at the previous all-time high anchored VWAP. This is the current anchored VWAP we're parked at, and this all-time high anchored VWAP has been recaptured. Once again, if I were thinking about a weekly threat for downside, if we had stronger sellers in this market, I would think that previous support could have acted as resistance with confluence there at the all-time high anchored VWAP. Sellers could have stepped up, yielded the weekly lower high. It just didn't happen. So the weekly trend, in my view, is much more likely to neutralize, if not flip to up, rather than continue in the downward direction. If we bring out the volume profile on the weekly, what else can we glean here? I'm going to drop this to a 2-year chart just so we don't have as much price data obscuring the profile. As I do something that looks like this entire thing has rebounded back over the major high volume node down underneath us. I would just point out that we're at the top of the next high volume structure. If you just wanted to consider this entire node here as a high volume structure, we're there, right? And in the intro, when I said you might not want to chase this rally here, this is exactly why. It's not unreasonable that the market may pull back off of this weekly resistance, right? And we just saw that with the anchored VWAPs as well. What I will point out, if you want to really split hairs here, is that the market did technically close up and over this high volume node, and there was really no resistance on the test of that high volume node. And we're also well above the bottom end of the zone. So if the weekly chart was going to pull back, you have a number of reference points underneath us here that could potentially act as a weekly higher low. Let's take a look at the daily time scale. Let's continue to get granular here. Let's firstly evaluate this week's expected move. If you're not familiar with the expected move, it's this gray shaded area right here. And if you want the video tutorial on how to set that up, check out the link in the top right-hand corner. If we're contained by the upper bound here, the number is at 579.82, implying a higher high in the daily trend count. And if we're contained by the lower bound, it's 553.69, implying a higher low in the daily trend count. Generally speaking here, I do think that evaluating the trend is useful because a lot of people are still in denial of this. First and foremost, let's actually start a little bit zoomed out. Let's just take a trend line from the all-time high doing something that looks like this. Undoubtedly, we've broken that resistance trend line. But you guys know me, I'm much more of a fan of horizontal levels. So let's count the trend off of the capitulation low as we've been dubbing it. If this is the low, this is a set of higher lows. This is a soft higher low because the hourly trend never flipped to down. We know that we had the 90-day pause high, which establishes a high in here. We made higher highs midweek. We went on to produce an even higher high into the Friday session. So undoubtedly, off the lows of this move, we are in a daily uptrend. And therefore, what I was pointing out about the lower edge of the weekly expected move is simply that if we're contained and we support here, it's a great spot for a potential higher low. But I would take it one step further and say there's enough leeway on the daily chart to really provide a higher low anywhere over the 90-day pause high, which is representative of the tariff turmoil zone high, right? This orange zone in here, you can see the orange level here, the orange level down here that's dimmed back, that's the tariff turmoil zone. As long as we're above that, I would be seeking a daily higher low to continue the trend in the upward direction. If we're thinking about this from a threat perspective, is there anything here that suggests a threat is imminent for a daily trend change? The answer is no. You can also see into the Thursday and Friday sessions, we had gap and go. That is indicative that stronger sellers are not really getting active in this market. You can see that there was no pure rejection of the daily 50 SMA, which is the blue moving average here. And we're basically running straight into, as we mentioned in the intro, that technical resistance overhead. So please be mindful of your trade location as we start to approach this weekly equal high. Recall that if we make this move, the weekly trend neutralizes. It's definitely no longer down. There's no chance for it to remain down. That's neutral. I would even argue it's probably up at that point because in my view, this is certainly starting to act as a weekly higher low as well. So in that sense, trade location here might just make us think twice about buying new money longs into the daily 200 SMA into this location here. It seems reasonable that the market may slow down as we approach this zone. So please, one more time, I've said it a number of times now, please mind your trade location around 575.50 in the S&P. It would be much more ideal if the market made some sort of move and then pulled back, right? Some sort of pullback into this zone. Let's make another comparison here. Hopefully you've made it to this point, because if this was a V-shaped recovery and the market was just going to go straight back to all-time highs, it should have happened here, right? The 90-day pause should have happened. We should have pulled back for the higher low over this. Let's actually zoom in a little bit on this, right? 90-day pause kicks off the V-shaped reversal. This should have held and gone nonstop. It didn't happen. So let's make a comparison to the closest thing that we have to a V-shaped recovery. It's this, the yen carry trade that we had back here, correct? So if we think about this in terms of using this as a framework, let's draw this level in right here. Let's draw this level in right here. Can you see where I'm going with this? Even when the weekly trend neutralized, right? This was a weekly lower high. When the weekly trend neutralized, there was one day and then the market balanced off into a multi-day range. And then we pulled back. Where did we pull back to? This previous low. Again, maybe we have one solid up day. We start running into some resistance here at the weekly neutralization of the trend. We don't want to be new money longs here. We look for the pullback. Ideally, if it is going to mirror this, it doesn't have to be the exact same, but if it's going to mirror something similar, a better higher low entry point is absolutely much closer to 551 and 546.75, the top end of the tariff turmoil zone. If I was going to use a line in the sand, it's definitely the orange level, the top end of the tariff turmoil zone. Once again, 546.75. Let's take this down to the hourly time scale now. Let's get a little bit more granular with the actual pathing into the early stages of this week, but not without firstly evaluating the Thursday and Friday session, because once again, we did have a gap and go on Thursday, as well as Friday getting follow through in the upward direction. So on the Thursday session, when the market pushes over the key level at 562, which was coming from off to the left, we talked about it last week, we then set a lower high back below the level. So you would think, okay, look above and fail, not unreasonable that the market maybe comes in for a pullback. On Friday, if we had opened inside of range here, it would have been very easy for sellers to breach the low, because the daily structure, if you just extrapolate here to the hourly, right, is the inverted hammer. If the sellers were to have breached the low, then great. We could have looked for support here. We could have looked for support here. But generally, the premise would have been that we would have accomplished some sort of pullback. That did not happen. And instead, you can see the pure play flip into the morning session on Monday. Monday pulls back into that exact same level at 562. And instead of enticing sellers to sell there, it actually acts as newfound support. The market rallies into the close. So generally speaking, the hourly trend is still absolutely in the upward direction, and there's no evidence, as this push has been taking place, of new sellers entering the market, aggressive sellers who are willing to keep prices lower. So in terms of pathing as we move forward, what is exactly the idea that we are looking for? And then we'll talk about anchored VWAPs and Fibonacci. If we get consolidation here, it's undoubtedly bullish. I wouldn't really want to be a bear looking for resistance here and oh my goodness, it's a big short. If I am going to be looking for a short, it would be a look above and fail, very similar to what happened on the Thursday session as a matter of fact. And then we set some sort of lower high underneath 569.75. Lower high here starts to do what? Of course, we would label this as a head and shoulders. Underneath the neckline may start to kick off some kind of pullback to get us towards that daily zone we were just very interested in, right? That's that 551, 546.75. That's one situation for the sellers to try to change the hourly trend here on a look above and fail at 569.75. That is the bear case, right? If we're looking for the bull case, it's consolidation here, Brigade bolt above, maybe you trade the long from point A, let's call it, to point B, but I would not overstay my welcome. Once again, the idea here, the analysis suggests that the buyers are in control. There's really no stronger sellers stepping up, but I would just be cautious of that trade location as we approach this weekly equal high to neutralize the trend. So at point B, I would probably do something like trim 3/4 of my position and then see if we can get a quarter to run to the next target overhead. If it does, then fantastic. We still have some exposure, but I'm not just blindly going to be holding the entire position, as we near resistance, as we near targets, with the risk that all those unrealized gains evaporate and ultimately something like this takes place. Because we know that this is reasonable. It's not unreasonable for the hourly trend to change to down such that we can provide some sort of daily higher low. Recall that for a higher low to be firm on the daily trend count, the hourly trend actually does need to flip to down. It's why this back here is only a soft higher low in the trend count. So generally speaking, those are my ideas. Consolidation, Brigade Bolt, quick scalps to the upside, longs don't overstay your welcome at 575.50. If it does fail for an hourly head and shoulders back below the level, I would look for shorts to trade scalps like this. For deeper pullbacks into that 551. When we get down here, I am absolutely open-minded to actually seeking with a vengeance, not quite a vengeance, but seeking this 551 reversal for the next daily higher low to be produced to continue the trend in the upward direction. Let's zoom out here. Let's take a look at some Fibonacci's just to be completely exhaustive of what's happening here. Let's come in from this last major low up to the high, and would you look at that, your Fib 38.2 is right on the money at the ideal daily higher low 546.75 being reinforced with that Fib 38.2. If you come in from the fake breakdown low of the Wednesday session and then come up to the high here, notice that your 61.8 is right at the 551, also reinforcing that level as a key zone to be thinking about buying opportunities here rather than new money shorts, right? I would not be looking for new money shorts unless, we talked about the scalp, right? We talked about the scalp to get here, but really stronger shorts are only in play if there's something that looks like this. And notice that this would be massively extended through the lower bound of the weekly expected move. One of the helping factors as to why this may be a decent long opportunity is because the market's pricing that in as the bottom edge of risk. If we start to get extended beyond that, a little bit of snapback here back into range would not be unreasonable. If we take a look at some anchored VWAPs on the intraday, you can see that we're above the entirety of the cluster. This solid white anchored VWAP from back here is the all-time high anchored VWAP. Obviously, we're above that. We're above all of them. And that is support. This entire band is going to act as support. The top of the band right in our key zone. Once again, confluence there at 551 as well as 546.75. So pretty thorough in the investigation here. I think we just want to be very mindful of our trade location if the market continues to grind in the upward direction, noting that it's not unreasonable for a pullback off of the weekly neutralization of the trend as we approach that last lower high resistance, 575.50. Daily 200 SMA, it's all right there, right? Let's take a look at our market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see? Generally speaking, all things are go. It's all systems go, right? Look at the inflows on the Thursday session on the gap up. It closes weak down towards the zero line on that end of day route. But the point being is all day, it's not like a majority of things on the exchange actually flipped back down inside of the Wednesday range. That simply did not take place. You had decent volume inflows there. Really strong inflows on the Friday session. Friday's in trend higher zone out of the advanced decline line. Positive here out of the advanced decliners on the Thursday session. The index score looks decent. I wouldn't say it's the strongest thing in the world on Friday, but it's decent. And then you can see that we have a cumulative build that's positive on Friday as well. Thursday does end up closing negative with sort of this look above and fail, lower high into the afternoon. So once again, the way that I would frame this personally is if sellers were going to make a stand, after Thursday was the day to do it. And you might say something, well, the China news overnight skewed it. Well, so be it. That's the nature of the market, right? And you can clearly see that previous resistance clearly acted as support. So it doesn't matter if you're talking China news or not. Notice that this happened on virtually zero volume through the overnight session. This happened on substantial volume. I would certainly trust this move far more than I would trust this move back here. So I am of the belief that the internals support the idea that new sellers are not getting aggressive or active in this market, and therefore the buyers have the edge. Let's take a look over at our good friend, the market profile, over here on Tradeovate. Can we get a little refresh? Looks like the answer is yes. Let's get into these accounts here, and let's jump into our full screen market profile. Let's do that here. There we go. ES, what do we have out of the ES futures? We've got ourselves a pretty decent move out of the value area, progressing higher. And the reason I say that is really because Friday was cleanly over the Thursday value. You can see that from here to here. And by the way, if you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. But generally speaking, the value is progressing higher. The point of control is progressing higher. And I would also just go all the way back to the Wednesday session. If you missed the Wednesday midweek market update video, what we called out from a market profile point of view is simply that this, right, did not rotate into the single prints here. On that liquidation off the open on Wednesday, the market found support over the bottom end of the P-shaped profile here, right, over the bottom end of the bell from the P, which is bullish. Stronger sellers would have no regard for that and would have just driven prices straight to the downside. So stronger, nuanced buyers are more so in control of this market. The next thing to point out as well is on the gap up from the Thursday session, the spike was not even tested. Remember, M period back here represents a spike, and there was no acceptance even in the spike, near the spike. We didn't even come close. That's why we have a partial gap close that remains unfilled underneath us. So market profile supporting the idea that stronger buyers are absolutely in control here. Let's jump back on over to the platform and let's take a look at our good friend, the nasty NASDAQ, through the lens of the QQQ cash ETF. Let's go up to a monthly time frame just to be congruent in the analysis. Let's take a look at the clean set, and you can see the same exact thing. It's actually even better, right? The monthly bar here has closed inside of the previous month's range. It's a green monthly bar instead of red, so we actually recaptured the monthly open for April, and we've already produced a higher high on the bar-to-bar count for the month of May. Really bullish stuff happening here on the monthly. It's really a rinse and repeat of the same analysis from the S&P 500. Same concept here, previous resistance acting as newfound support, well above an upward sloping 50 SMA, and we do not have the opportunity for a monthly trend reversal. If we drop it down to a weekly time frame chart, and take a look at this, we've already neutralized the weekly trend. It's no longer fair to say that the weekly trend is down. I would start arguing for a neutral weekly trend, if not bullish weekly trend. In terms of candle structure and location, very similar to our good friend, the S&P 500. We have a solid green-bodied bar, substantial lower wick, noting that once again, the lower wick did puncture this previous low, which could have acted as a lower high resistance here. That was not the case, and the buyers were able to close strong towards the highs of the weekly range. Let's take a look through the lens of our Fibonacci's from the highs down to the lows here. We've parked ourselves right at the 61.8. The S&P is a little bit stronger with a close over that from a range point of view. But again, I would balance that data point here and not be overly concerned because the weekly trend out of the NASDAQ has already neutralized with the equal high. So not the end of the world that we're still at the 61.8 instead of closing above. If we come in, I mean, this is just virtually a 100% retracement from the last lower high, all set from that point of view. Weekly anchored VWAPs for the NASDAQ were above the entire cluster, even the previous all-time high anchored VWAP happening here. That means, once again, if the weekly trend was going to pull back or offer a pullback for a higher low, I would be acutely aware of roughly 470 on the QQQ. Let's take a look at the daily time scale here. And, well, I suppose, yeah. Let's go back to the weekly. I always like being congruent, so let's take a look at our volume profile, just to make sure we're not missing anything obvious. We did close over the high volume node here, and I did want to call that out because, once again, the threat would have been that you reject underneath that for a lower high, and it's simply not what's taking place. So if we do pull back now, I would certainly want to see this act as support, because if we extend this, right, you want to see that act as support, and then a prompt recovery up and over these equal highs gives you something like a weekly inverted head and shoulders, right, if the pullback fills in that right shoulder here. So that is the weekly view. Let's get down to the daily now, and we'll take a look at our expected move for the week. We'll talk technicals and what's going on. So expected move is here. Upper bound is at 501.90s. 501.90s. That is a blur in the lines up there. 501.90s on that, and the lower bound is at 475.66. We have the same idea as the S&P with a higher high or some kind of major higher low. Same concept in terms of counting the trend here, where we have lows, we have higher lows happening here. This is a soft higher low with the hourly trend never flipping to down. We have highs, equal highs, higher highs, and we're currently parked at the highest high in the trend count. Now, as we talked about in the S&P 500, we do have that resistance overhead. Notice that the NASDAQ is already there. It's testing the daily 200 SMA. Notice that the 200 SMA acted as resistance back here for what was a look above and fail. Look above the range, fail back into the range, lower high here, Armageddon. So I'm not calling for Armageddon, and certainly if you've watched up until this point in the video, you know that I have a more bullish bias here, but it wouldn't be unreasonable to sort of dial it down on the tone for longs and just say, okay, trade location might suggest that a better pullback in here, something that's even a gap fill reversal, out of the NASDAQ looks a little bit better. Something that's in here starts to become a little bit more enticing for a potential new money long entry, where then at least you can manage risk and say, okay, here's my risk, here's my reward back up to the equal high. Now I'm working with something like a 2-to-1, 3-to-1, depending on the actual execution. Just like the S&P 500, I would go out on a limb and say that as long as the market can hold a higher low on the daily time scale, over 465.85, the buyers are in control. So on the daily, it's really gap fill reversal here, up to the highs, or if we pull back deeper than that, show me something that looks like this. You could say your higher low here is also interesting. Those are the daily game plans. If you do just get straight up continuation, I'm not going to fight that, but once again, I would just be cautious of your trade location. So when I say in the intro, do not chase the market rally here, I mean, intraday scalps, fine, but new money longs in the grand scheme of things at an equal high, after producing this rally, I think that the trade location again shines through, and you're not really effectively managing risk with a reasonable data point for your stop, right? From my perspective, at least as a trend follower, I'll give you the example. If you're a new money long here, it doesn't really make sense to put your stop, at worst, maybe just underneath the gap close, which means that you're risking about this much. To get a 2-to-1 return on your money, I mean, you're talking about needing the market to go towards all-time highs, which, I mean, it's not unreasonable that might happen over the span of time, but certainly in the short term, I feel as though we could probably get more nuanced and better entry points, right? And that's like the conservative, really tight stop underneath the gap. More realistically, I would say that you probably want to stop here, underneath something like 465.85. So now think about it like this. This is representative of your risk, and this is representative of your reward to the all-time high. That's not even a 2-to-1. I mean, you're talking about maybe like a 1 3/4, 1.18 or something like that risk to reward ratio. So that's how I'm thinking about the location of this current bar here. Also note that the daily bar out of the NASDAQ, a little bit more upper wiki off of that moving average. Let's go on down to the hourly time scale. It's a rinse and repeat here, where you can see the same idea. Market looked above, failed with a lower high here into the afternoon of Thursday. Sellers were unable to follow through for a gap close, and therefore, right, we don't have stronger sellers entering the market. I'm not suggesting that the market's going to crash and burn and go to zero. I'm just saying be mindful of your trade location, right? Location, location, location. Just like real estate in the market, location matters quite a bit. So what I would look for if a pullback was going to develop might be something along these lines. Look above and fail on 493. Very similar. Once again, take this exact template, apply it right here, lower high underneath 493. Trading for pullbacks, ideally some sort of gap close, then has me interested in longs. I would say that this higher low back over 480.75, the Thursday low, could be interesting. If you could spot the gap fill reversal pure play off of 477, it's an interesting spot for a long there as well. If we move underneath that, that's where I would say that this really, as a referenced hourly range, could be where we start to develop a stronger short thesis to get here. We would trade from point A to point B as a short, not overstaying our welcome in a daily uptrend. What does that look like? Well, let's say that all of this plays out, great lower high here. We close the gap, the market consolidates, and then we brigade bolt like this. I'd be willing to take the short from point A to point B. But when we get to point B, once again, I am not overstaying my welcome. I am more so interested in the reversal and playing something that looks like this back up to the high. If you're an astute trader, you could probably pull off the higher low here from the daily time scale at 565.85. Those folks looking for a little bit more confidence on an hourly higher low probably just play the move back over 477 coming from the top end of this previous range from back over here. It would also be a recovery of the daily 50 SMA. Things go to hell in a handbasket, absolutely, and we will admit this if the time is correct and the market does play out this way. Let's say Jerome Powell is like, nope, we're hiking rates. If we get something that looks like this, yeah, that's detrimental. Any lower highs underneath 465.85 become an issue for this market. Just to zoom out here a little bit and backtrack just a hair, I do want to at least prepare you for some upper targets and at least, hopefully you can see where they're coming from. Let's get the zoom right here on Thinkorswim. Thank you. Sometimes the platform acts up. You guys know that. Previous resistance there is at 502. 502 what? 502.65. Really tricky on that overlap with the upper edge of the weekly expected move. And then the next major overhead supply comes from this weekly balance there at 510, just to prepare you with some upper levels if the market goes for this massive rally in the upward direction. Let's take a look at the anchored VWAPs intraday, and then we'll look at our, of course, Fibonacci's. We're above the entire band segment here. Once again, the top of the band is confluence with our 465.85. It's a rinse and repeat of the S&P. This pullback here, right, which kind of failed, right? This also left an unfilled gap in the chart, is going to be creeping up closer to, depending on time of week, that 477. So if the gap does close underneath us, that would be a great spot. Looking for confluence, lower edge of the weekly expected move, anchored VWAP, perfect. The last thing I'll say here, which we didn't really acknowledge on the S&P, but we'll say it here, is if these gaps just remain unfilled, you have to carry that forward as a bullish data point. Why? Because sellers are simply not doing their job. They're not fading the overnight inventory. There's no correction of the overnight inventory. It's not like longs are getting, ahead of themselves in the overnight and the market corrects that intraday. The market's just showing you that prices are accepting up here at these higher ranges, which inherently is bullish, right? Let's take out the Fibonacci's from the bottom of the move here up to the high, and your 38.2, beautiful confluence right off of the key higher low zone. That's that 465.85 level. And if we come in from here, do we get the same thing? Not quite. 38.2 is right at Thursday's low, perhaps worth carrying forward, but I would still, in terms of hierarchy of importance, the gap is more important than the Fibonacci's from this perspective here to here. Let's jump on into our good friend, the market internals for the NASDAQ side of the exchange. You can see a rinse and repeat of the S&P analysis, right? The key question to just ask here and answer via the data points is, are stronger sellers getting aggressive on that end of day route from Thursday? I mean, not really. The volume flows closed positive. Really strong inflows on Friday. Correlated, yes, on Friday, right? In trend higher zone here. Positive on Thursday. Big recovery on Wednesday after the gap down. That was the GDP print, right? You could see that on Friday. Strong cumulative build here. On Thursday, decent build. I'm not going to say strong, but it was positive relative to the S&P, which was negative, right? So all things considered, it does not seem as though sellers are taking advantage of any of the opportunities that have been given to them to yield lower highs or even just remain inside of the tariff turmoil zone. It's not happening. Let's take a look back over here at the market profile for the NQ in particular, zooming out and seeing what we can see here. Let's make sure we can kind of see the letters. There we go. What do we have? Rinse and repeat of the S&P. That's what I would say. You have your value area progressing in the upward direction, obviously progressing higher with the point of control as well. Point of control is higher on that Friday session and completely clean to the upside relative to the Thursday value. I will say that Thursday has a poor low here. That's mechanical. That will need some repair at some point. I'm not saying it has to happen this week, but if we do find ourselves under the circumstances of a pullback and we're testing Thursday's low, I would not be buying Thursday's low as an area of support. I would be selling that for a quick scalp as the gap close into this level down here. Of course, that would be the Wednesday high. Similar story as the S&P, where if you take a look at the Wednesday market profile lows back here relative to these single prints, sellers were unable to rotate through that zone. Once again, a more bullish and optimistic take. Same commentary as to the spike as well, just not even tested on that Thursday gap up. Let's finish off the broad market with the IWM Russell 2000. See what's going on with smalls here. Let's jump up to a monthly time scale. Let's take a look at a couple years at least. Let's go 20-year chart is fine. Let's see what's going on. So we still have the hammer candle for the ages, but if we want to get really nitpicky here, notice that the close is technically underneath the previous candle's low. It's still a strong lower wick, but it's not as good as it could have been relative to the S&P and the NASDAQ. You could still see that the May bar is starting to shape up as potentially threatening the high of the April bar. That is yet to be seen. And generally, this area right here is really what we care about. It's the monthly 50 SMA. It's the top end of this balance range from back here. It is the do or die level for small caps. Now, with the FOMC this week, I think that you're going to get a particularly sensitive move from IWM based on Jerome Powell's commentary. If he doubles down on being a dove, you better believe IWM has the opportunity to break out over that $200 mark. If he is hawkish and he continues to say, we're going to be data dependent, I think that inflation is going to ramp up here based on the tariff impacts and so on and so forth. We're going to sort of stay the course, keep rates a little bit higher. Small caps are not going to like that. We did start to see a small degradation of the labor market based on the weekly continuing claims. Obviously, the monthly report came out fine because that was encapsulating the April data, but the week-over-week continuing claims did start to break out. We'll get to that as the show wears on. I think Jerome Powell, if he acknowledges that the labor market is starting to, I don't want to say crumble, I don't even want to say crack, but if he's at least acknowledging that the labor market's going to come first here, that would probably be a dovish enough indication for small caps on the monthly to get up and over that 200 figure. As we take a look at, we could just, from an interesting point of view, come in with the fibs from here to here, we're still under the Fib 38.2 as of, maybe right at it as of the Friday close, May 2nd. So not as much progress has been made back in the upward direction compared to the S&P 500, which is trading up and over, as we know, the Fib 61.8. Let's drop it on down to the weekly time scale, and we could see a little bit more optimism on the weekly. In terms of candle structure, very similar to the other two indices so far that we've covered. We have a solid green-bodied bar with a lower wick. I would not call the lower wick here, though, as meaningful, just noting that the weekly lower high can still persist up against that $200 mark that we were just talking about. It's actually the weekly 200 SMA as well. There's really no surprises here on the weekly time scale. We know that the 200 figure is just the big watch for small caps, so let's not, let's not belabor the point, so to speak. Over the 38.2 in no man's land, it'd be better if the small caps could break out a little bit more firmly and hold over this Fib 61.8 here for the 100% retracement to neutralize the weekly trend. You're just not at that point yet. Let's take a look at the anchored VWAPs for small caps here, and I think we have to grab more time to properly anchor the old ones. Let's go to a 5-year. Yeah, there we go. Let's take a look. We are underneath the majority of the band. We, unlike the S&P and the NASDAQ, have not cleared this. This is the same equivalent on the S&P and NASDAQ. We're still at it instead of above it more firmly. This certainly acting as big resistance overhead. Even if you wanted to consider that the weekly trend reversal stemmed from this as a head and shoulders, you might say something like, okay, your neckline is here. I mean, not to get too crazy, but you could still find a weekly lower high from here to here. It's probably a monthly lower high at that point, suggesting that the trend is not fully resolved in the upward direction. So small caps have a lot of work to do, and I think it makes total sense given the huge bifurcation of the market. I mean, you think about technology and what we heard from Meta and Microsoft. Those companies are going to weather any recession just fine, versus Main Street is like, oh my God, like these tariffs are crushing us. Obviously farmers are feeling it quite a bit right now. I mean, small caps really representing that Main Street more so, not saying the same thing as the two majors like the S&P and the NASDAQ. Let's take a look at the daily time scale. Let's reset this way. Let's go to the daily here for the IWM. Let's talk weekly expected move trend, the whole 9 yards. Here we go. Weekly expected move 206.25 on the upswing is a higher high, and on the bottom end, if contained, 194.68. That, of course, would be a higher low here. I actually think that this mildly qualifies as a higher low on the hourly. The trend was loosely down. We'll see that in just a second here. So expected move is bullish, and most importantly, I think that there's some degree of optimism on the upper edge, suggesting that the market may move and hold up and over that $200 mark. So really, if you wanted to treat something as a zone, I would think of this as a zone here out of IWM. Anything that's sideways in this zone, let's zoom in a little bit further on that, make it a little larger on the screen. There we go. Anything in here is a little bit more neutral. I mean, it's bullish to neutral, right? But it's still that weekly lower high threat, that monthly lower high threat does not fully resolve that major 200 zone. If we get something that looks like this to the upper edge of the weekly expected move, there's a mild level in here, but I would really be targeting something like the 209.25. Based on the breakout of this range, I think that balancing in here, or like a range double, our target basically is this 202.75, which is the lower high from there, right? So I'm not convinced that small caps should rip and roar unless Jerome Powell really comes out being a dove on Wednesday at 2 o'clock, which, speaking of, we will be streaming that live here on the YouTube channel. Come on out to the show. We'll not only be doing the pre-market preps as we typically do, but 2 o'clock on Wednesday. We'll probably start the stream at 1:45. We'll see what Jerome Powell has for us. So small caps daily chart has broken out of this balance range on Friday. It's helpful, and this is on the heels of the labor report, which came in better than expected on the non-farm payroll, but the continuing claims are, I think, where things are getting a little bit shaky. We'll dive into that momentarily, as we've said. Let's drop it down to the hourly, though, and let's continue to talk about price action here. You'll notice that, on the Thursday session, there was much less of a look above and fail, and it was just balanced outright. So the fact that Friday is breaking out more firmly, to me, is just a decent indication that, yeah, buyers are doing what they should do as we clear a notable area of resistance. There's a small gap in here that's unfilled. I don't want to get too level happy on the charts. We're not going to label every little minute detail, but that is there. You could carry that forward as a bullish indication. If the market pulls back, ideally, you just want to see that gap fill reversal offer support at the weekly threat, right? If we can start supporting in here, it would at least help the case that sellers are not getting aggressive on the higher time frames. If the market just gets crushed, small caps in particular get crushed underneath 198, 197.50 if you want to use the level from here, and then do something that looks like this, that is a look above and fail on this balance range here, that would be pretty detrimental for the higher time frame. So really, carry forward 197.50 as your key level out of smalls. If we want longs in the S&P 500 and we want supporting evidence, consolidation here is fine. I would go with it. Breaks are obviously supportive of upside in the S&P. If we start failing and lower highs emerge underneath 197.50, I would be a little bit more concerned, or at least just not as confident size-wise in the S&P 500 fishing for longs, right? That's how I'll be using small caps here. Let's quickly check in on the intraday anchored view apps. We're above the entire cluster, and maybe you give this the benefit of the doubt and say it's 195.15. This is the balance range here. If you can support over that, maybe you're okay. I would still really use that Thursday high. Reason being, of course, is we know that it's much more of a firm indication of those previous weekly lows, right? And we want to make sure that we stay above that. It's 197.50. If we come in with the Fibonacci's from the low of this move up to the top of this move, the 38.2 is probably too much of an overshoot here to be any use in terms of confidence as a gauge. If we come in from the bottom of the balance up to the breakout high, 38.2 is a little bit of confluence there, but you're dealing with a smaller move at this point, a little bit less in terms of the hierarchy of importance. I would really play into the key levels here being ideal for the IWM versus those Fibonacci's. Let's check in with the market internals for the Russell. You can see decent volume inflows on Friday, but not substantial in the same sense as what we had as the S&P and the NASDAQ. Thursday's not as bad as the rollover into the end of the day. You can see we're still in trend higher zone here out of the advanced decline line. We do have a decent cumulative build out of the tick, and Thursday's a bit more mild than some of the others, right? We saw the NASDAQ, which was a little bit more positive. So I think that the point still stands here in small caps that we don't have stronger sellers stepping up, but you might just want to be cautious of the weekly threat for that major level, right? And again, this is subject to change as Jerome Powell takes the stage, really the podium, on Wednesday at 2:30 is when the press conference actually takes place. Let's jump into the Rusty Russell market profile. Let's see what's going on from this point of view. And let's see what we can see over here. Generally, rinse and repeat. No need for additional commentary. Value is progressing higher. We do have a poor high on that Friday session, which is worth carrying forward. This is an unfilled gap happening here. There was no gap. Whoa, all sorts of funky zoom. There was no gap on the Thursday session. Notice that we opened right at the Wednesday high. A period has plenty of excess here. That is a secure low out of Thursday. So looking good out of that. Let's quickly reference the single prints back here. A little bit of a deeper dip into those singles from A period there on the Wednesday drawdown, but you could see that the market reversed firmly out of it. Point of control was certainly higher on that session, so not a huge concern there. Profile, to me, more indicative of buyers being in control, and if there was a pullback, that's not unreasonable, right? If you think about toppling over, something that's top heavy, notice how the value time spent on that Friday session was higher. Anything that's underneath, there's a small double distribution here. Anything underneath like 20, 25, 30s on RTY may cause a pullback, and once again, you're really looking for that Thursday high 2000 to act as key support. Let's jump back over to the platform here. Let's get a little bit deeper into the S&P sectors now and see what they might be telling us for the week ahead. As we take a look at the weekly performance, who was leading, who was losing, and where was the weight? Industrials leading the pack up 4.14%, followed by the tech sector, then semiconductors. At the bottom end of the barrel, it's going to be the TLT bond, and then we have, so let's just not even include that in the bottom three, but we have energy, we have healthcare, and we have consumer staples. Now, I don't know about you, but this is definitely looking a little bit more risk on versus this being a little bit more risk off towards the bottom. That sides with buyers being in control and risk appetite remaining elevated as this breakout is taking place in the upward direction. Let me just say right off the bat, I would be massively concerned. And we talked about this on Wednesday, right? We said that we needed to see improvement out of the risk on sectors based on the earnings of Meta and Microsoft. And that's exactly what we got into the end of the week. It would have been a white flag turning into a red flag if the risk off sectors were leading this breakout in the upward direction, but that's not what we're getting in terms of posture. Posture is risk on here. As we look at industrials, let's rip through these technical charts. We are making an equal high, so the weekly trend has neutralized. Plenty of room for a daily higher low. Call it the inverted head and shoulders. We're good to go. Not an issue. Let's move along to the XLK, rinse and repeat of the QQQ, basically, where we're at the weekly neutralization of the trend. Plenty of opportunity for a higher low pullback here, and I would not even blink twice about the trend being in jeopardy. If we start to find acceptance underneath 206.40, that's a different story. But for now, this is bullish until proven proven otherwise. Let's take a look at semiconductors. What do you know? It's a similar story, not quite the same, but similar. It would be better if semis could make the equal high up around 230.50 to neutralize the weekly trend. However, I am pretty thrilled that there was pretty much no looking back after we had broken over the 90-day pause high. That's 211 here. So ideally, higher lows and Brigade bolts get us to neutralize the weekly trend, and that also just continues the daily trend. So 211, key level here out of semis, looks great. I think that the inverted hammer might suggest, okay, a little frothy, be mindful of that trade location as we've been touting this entire episode. A pullback to get here, longs off of 211, probably set up decent trade opportunities, honestly, in names like NVIDIA, Broadcom, TSM, AMD has earnings on Monday. We'll see how that shakes out. But the semiconductor names, they look pretty good, ideally on some pullbacks, right? But pullbacks and semis, name of the game. Let's take a look at real estate. Rates kind of fluctuating still, but real estate responding well, moving higher in here. I think one of the things that we should certainly keep in mind is that there's not a 2008 situation where real estate is going to get absolutely demolished, if these tariffs, continue to provide volatility for the market, which on that note, we'll get to the fundamentals momentarily, but it seems like tariff volatility is in the rearview mirror and nobody cares about tariffs anymore. We're in complacency mode. There's no issue with it. XLF, what do we see out of financials? Huge higher high. No longer in a weekly threat. I think that there's room for a higher low here. There's room to continue to the equal high. The trend is up. We've recovered substantially off of these lows from back over here. Huge move in the upward direction. Financials were acting as a strong leader for the S&P through this entire move in the upward direction. I'm curious to see if they take that spot again or if the baton is going to get passed back over to the XLK, the technology sector, right? And this is really going to come from the push and pull between people uncertain about the future and financials versus big tech, which has unlimited deep pockets and can continue to spend on AI infrastructure. So I'll be watching that closely just in terms of relative performance. If we look at the XLC, rinse and repeat the analysis, higher low here looks great. As long as we're over 95, not even blinking twice about threats here. As we look at the XLB, we're over a key level. This is the lightest weight sector in the S&P. It's not going to move the needle even if it does fail, but 82, I would really just use top end of the tariff turmoil zone at 81.30. Let's move into utilities. It's a risk off sector. It is technically poised for a breakout of this balance range. We'll see if that ends up being the case here. On a move over 80.25, I think that, again, thinking about the theme of rotation in our sectors, this would be fine. Let's say that the XLU breaks out of range here and causes some upside as the XLK and SMH pull back to set higher lows. What's that going to mean in the S&P 500? The pullback is going to be small and contained. Remember that rotation is a good thing for the market, so I'm not overly concerned with your XLU poised for a break over the 80.25. As we look at the XLY, consumer discretionary, chart also looks great. There's plenty of room. We already sort of got it a little bit here for the higher low, but I would say a firmer higher low on a stronger hourly downtrend that tests and holds 192.75. I mean, come on, we're building out inverted Man Ray patterns on all over the place in the market, over the neckline, over the daily 200 SMA. In my view, that's a bullish reversal here out of discretionary, setting up for continued risk-on posture in the S&P. As we look at the XLP, it's the same story as the XLU, right? It looks like it's poised for a break of 82 in the upward direction. Remember the rotation theme. If this breaks out as technology pulls back, let's go to the XLK just for kicks. If this happens in the XLK, but at the same exact time, this is happening in the XLP, you probably still pull back in the SPY itself, but it's going to be a mild pullback. Not everything is moving in the downward direction, right? XLV, what do we have over here? We've got ourselves a failed breakout over the top end of the range here from the tariff turmoil. I'd be a little bit more open-minded to neutrality out of the XLV. This is a heavier weight sector, so definitely keeping in mind if this fails and rotates all the way down to the lows, that would kind of be a shot across the bow. Why is healthcare not really performing well across the recovery, broad market-wise? If we look at the TLT, I still don't think, it's starting to show us a little bit of something where maybe this lower high here is meaningful enough to send the TLT back lower. Into an FOMC meeting, though, it just becomes a little tricky. What's the setup here? Maybe short TLT on a move underneath 88.25 for a lower high. And of course, the premise just being that the interest rates, of course, moved higher. People sold bonds on the idea that the labor report on Friday came out better than expected on the NFP. I don't think that that's going to last, though. So honestly, it would seem to me that bonds might actually catch a wind on any bit of a dovish Powell. That's kind of the way I'm leaning. And, I sort of hinted at it in the introduction. a surprise rate cut in this meeting I don't think it's going to happen, but it's in the realm of possibilities. I would think that it's greater than a 0% chance, or even I'd say it's a better chance than what the Fed tracker tool is even pricing in. So we'll talk about that momentarily here. Energy, it's got to get up and in gear. Otherwise, we talk about this recession narrative, and this ultimately is why Jerome Powell may be forced to cut rates. I mean, you're seeing the signs of economic slowdown. I'm not going to say that we're like approaching recession and oh my God, but usually by the time the hard data starts coming in to the degree in which a recession is going to be called, it's too late, right? And the Fed's going to respond too late. So we'll see, but energy, watching it closely as a proxy for global demand and whether or not, again, recession remains the key theme. As of right now, the lack of breakout certainly suggests that, yes, that is still a major threat. Let's take a look at some ratios here just to gauge whether or not we have a risk-on or risk-off environment. Just like the actual look through the sectors and the posture, we could see similar, right? The XLK continues to offer green shoots. That's bullish. XLY really needs to get in gear on this higher high breakout over the previous pivots from there, but I do at least want to acknowledge that, yeah, it's trying to hold some kind of higher low there. If it's an ascending triangle breakout, that would also qualify as green shoots. So let's maybe just call it check mark here, neutral out of discretionary. Financials still look great for a higher low over the upward sloping 50 SMA. Let's work ourselves back up to the equal high. Not concerned with defensive healthcare. We can see that communications look okay here. Industrials even look okay, and the risk off sectors are pulling back. We're finally getting those interactions at the daily 50 SMAs, the gold moving averages on all of these charts, which is meaningful as a first step to start reversing the trend more firmly on the higher time frames. Let's take a look through, of course, some specialized ratios. Green shoots here. This is technology versus the SHY, basically cash. If you look at technology versus utilities, more green shoots here. Green shoots here. This is discretionary versus staples. And over here, semiconductors versus healthcare, also green shoots. It certainly looks as though as this bottoming process is taking place, right, this is holding as a double bottom, higher low, higher highs, this trying to break out. This maybe gets a little bit more of a neutral, but higher low, double bottom here breaking out. More of that risk on rotation is happening as the S&P is firmly clearing the 90-day pause high, the tariff turmoil zone high. So we're getting over that. The market is showing us that this is not a defensive rally. This is a risk-on rally. If we look at the ARKK, certainly the same thing. Strong sort of reversal out of this, inverted head and shoulders, but a lot of work to be done. I'm certainly not going to ignore the fact that this could act as just a container and put a lid on the rally. So as we're thinking about, could this pull back and offer a higher low? Yeah. Could this pull back and just sort of noodle around a little bit more? Yeah, not unreasonable. Still underneath the downward sloping 50 SMA. This, same story. It could easily provide a higher low, though, in a majority of these healthier risk-on environments, and that to me is the pinnacle of keeping in mind trade location here in the SPY itself, right? You don't want to just get long as these ratios start to pull back. They could still offer higher lows. It's not going to make them bearish, but your location is not going to align with the best possible opportunity for upside. Let's get into the B sectors, or at least the B ratios, I should say. You can see that gold relative to the S&P is falling off of a cliff here as gold itself dramatically pulls back. That's an indication that I don't think as many people are rushing into gold, and you're also not seeing the gold appreciation based on the dollar getting crushed. You're not seeing that sort of flight to safety, oh my goodness, let's get into gold, a safe haven asset. It's just sort of waning a little bit. Also, everybody saw it. Excuse me. You went parabolic on the gold breakout to the upside. We'll take a look at the gold chart in just a second. Bitcoin, risk-on asset, absolutely recapturing that 92,000. Sailor shift tool firing green. That's bullish. And finally, if you guys have been tuning in, let me know in the comments section, actually. This is, instead of waiting until the end or whatever, let me know in the comment section right now if you've been following along with the TLT ratio, because we were waiting for a larger breakdown in the TLT ratio to the S&P to not suggest a flight to safety unfolding. And that's exactly what happened into the end of the week as this breakout extended itself higher. Another risk-on indication here, right? So keep in mind, this could easily now set a lower high. And once again, trade location becomes key in the S&P 500, but the nature of the way that this breakout is unfolding is absolutely more constructive and with support from risk-on indications across these intermarket dynamics. Let's take a look at, I told you we would look at gold individually, so there it is. Gold pulling back. I'd be really curious to see what the reaction is here, around 3,200 an ounce. It sort of slowed down the pullback, at least on that Friday session, just an inside bar. If this can start to creep back higher and break out again, I'd be interested, but this is where we got to be careful, right? Because you don't want to trade based on feeling. You want to trade based on the technicals. However, if we are applying some degree of okay, we've seen gold, we watch gold, we've been watching it for years, right? This is definitely, I don't want to say, again, careful with what we label as unreasonable, reasonable. Remember, the market can always do whatever it wants, but I'm not going to call it an unreasonable move, but it is certainly an out of the ordinary move from gold, right? And maybe rightfully so, the catalysts were there. I would tend to think you're not going to continue this trajectory here, the slope of that trend forever. It doesn't mean that gold can't move higher, but you're probably not in store for a breakout of this magnitude again in the near term. So watching out for that. So again, 3,200 out of the GC contracts we'll be watching for. If we move into interest rates and the dollar, once again, if the dollar starts to perk up a little bit here, obviously gold should continue to get dampened a little bit in terms of its pricing, and it seems reasonable on the inverted head and shoulders. Now, I would be certainly aware of 101, previous support back here, possibly acting as resistance, but I think Powell's words are going to be going to mean far more than a technical level on this particular chart. As we look at interest rates, they're slightly higher on the labor report, being better than expected, which of course probably means that Powell is not going to cut in the meeting on Wednesday. However, let's take a look at the inverted ZT. We'll see the same thing, small little uptick here, right? Odds of a cut just basically went to zero. However, it's gone over to the platform. Let's take a look at the Fed Watch tool here. So it's currently saying that the odds of a cut are about 2.8%. I think the odds of a surprise cut, would honestly be slightly higher than that. Maybe this is where I start to step in as a small contrarian to what the market is suggesting here. And this is an opinion piece, right? We'll just continue to follow these odds as we typically do. So I'll tell you when it's my opinion versus what's actually going on with a technical chart. Opinion. I think that the tariffs, if anything, and the fear that's been stoked in the consumer right now is going to be more deflationary than inflationary. I don't think people are thrilled to go out and spend, even though credit card companies are telling us that people are spending. I think that continuing claims, as we just get into some economic data here from last week, continuing claims were released here. This is going to show you the jobless claims. This is initial at 241,000, missing the expectation of 224,000. If we look at the actual plot, though, this is the miss. All right, this is the miss to the upside. This is continuing claims breaking out to the upside of its most recent range. So again, this is not me saying, oh my goodness, because remember, my take is that the broad market is bullish right now. And remember that the market is not the economy. However, Jerome Powell looks at the economy and has influence over the market, right? That's the sort of sick and twisted game that we play. So with continuing claims breaking out here, I think Jerome Powell may have some incentive to be more dovish than he is hawkish in the coming meeting, regardless of how he has felt previously about tariffs causing inflation. If you actually look back at the Fed, basically the Fed had put rates down to zero for a long while, and absent the money printer, just quantitative easing that way, absent the money printer, inflation stayed under wraps ever since the great financial crisis, right? There was no inflation since then. It was very, very contained inflation. It was only when the massive stimulus from the sickness came through. So I'm not here to be an economist. I'm not here to say that my thesis is 100% correct, but that's kind of what I'm thinking about when I go back to this chart and say, okay, are the odds really only a 2.8% that the Fed is not going to do anything? I just think that the balance is perhaps skewed unfairly here. And I would think that the June timeframe meeting should probably start pricing in something higher, like almost like a 60-40 more evenly, or even 55-45 style split there for a cut in the June timeframe. So we'll see what Powell has for us on Wednesday, but that is some of the first data points that I would carry forward here. It's the fact that jobless claims and the continuing jobless claims are breaking out. So we take a look at the actual non-farm payroll, which was released on Friday. You'll notice that there was not much contraction here. The contraction mildly happened in manufacturing and other services, but notice the jobs that are, of course, added to some of the more important sectors in terms of earnings power, right? You certainly have financial activities in here, professional and business services in here, higher earning power in some of these. The government jobs number also increased, right? So in terms of the Doge impact, if you will, you're not really seeing that. Maybe you're seeing a slowing in hiring, and I would certainly say, right, as we just look back at the blue boxes in all of these zones relative to what it had been in the past, right? Government hiring is certainly slowing down, but you're not getting a complete negative print there, and you're also seeing an uptick in some of these higher earning power sectors as well, like health services as well. Oops, if we just point there's the 70 on education and health services. So not a concerning labor report, but remember that this represents what's in the rearview mirror. I'd be really interested to see and I know it's like you always kick the can down the road when it comes to the fundamental data, but I'd be really interested to see what the May report actually looks like as we move into June upcoming. And I'm sure Powell will echo some of that similar sentiment. Let's talk earnings here. I found this to be quite compelling on the earnings side. So the sector level change in EPS between March 31st and April 30th through the tariff turmoil. Take a look at the revision. So this is revisions to sector level EPS estimates. If I scroll up, you can read this up here. Where is it? So analysts making larger cuts than average to EPS estimates for Q2. Let's go back down to the chart now. Why did I find this chart compelling and interesting? Because information technology is here to save the day. It actually saw an uptick in the EPS revisions, right? The sector level change on EPS revisions was higher. And as we scroll down, we could take a look. Where was it? You could even take a look at this one. Right? This is for calendar year 2025, revisions from December to April, right? See what's going on here. Information technology, yeah, it's been mildly revised lower, but that's not going to influence the broad market, right? Generally speaking, you're not getting, if this was at the bottom of the list down here and revisions were down like 15% like energy, yeah, that would be a concern. But as of right now, what the market's seeing, and we saw this based on Meta's earnings, we saw this based on Microsoft's earnings. Amazon was a little bit lackluster, and Apple is just the total botch of AI. We know that. But CapEx is increasing. These companies have deep pockets. They're not even flinching at tariffs. And that basically is one of the reasons, and you're seeing it in the data here, one of the reasons that I believe that the market may disconnect, right? You're seeing that bifurcation between Russell 2000 small caps and the majors, just because these companies, again, don't care about the tariffs, basically. Amazon, again, might be a slightly different story, but when it comes to cloud providers, Meta spending on infrastructure, the writing's on the wall, right? This AI play, the tech trade, is going to continue to fuel the market. Another interesting data point, just to reference a podcast I was listening to, is what are people going to cut first in a recession? Are people slashing phone bills? Are people, are companies getting rid of their Office 365 license? Are they going to stop hosting things in the cloud? Probably not. I would think that if anything, consumer discretionary is going to get cut a little bit. So we're in a new world order, right? Where instead of utilities being the defensive play, it could very well be information technology, where companies can't afford to not use infotech products, right? And if they did, they would just not have a business. So utilities are not the defensive play. Interesting point of view. Anyhow, that is earnings insight there. Let's take a look at, actually, before we move on, I do want to go to the forward-looking guidance, because this was another topic of conversation that we continued to explore. It's that negative guidance for Q2 is equal to the 5-year average. It was below the 5-year average, negative guidance below, so less negative guidance was below before this week. But even as of this week, post Meta, post a number of companies, right, we're just at the 5-year average of negative guidance. You would think that with all the tariff volatility and uncertainty, this number would be skyrocketing. It's just not the case. So certainty from the CEOs, CFOs who are on the earnings call, giving people a little bit of peace of mind, it's definitely more of a bullish indication. Looking forward to earnings this week. What do we have? The big one is going to be Palantir, in my opinion. Obviously, Berkshire is having their shareholders meeting this weekend. It's really cool that if anyone's there, let us know in the comments section. I see a lot of people online there. Anyhow, what else is interesting? Probably Datadog from a tech perspective. AMD definitely is going to give us some updates on the state of the semiconductors here. Uber should be an interesting one with Ackman's big stake that he's just announced. I would say that AppLovin's been destroyed recently. I'd be curious to see if even bad earnings provide some sort of uptick out of the name. ARM from a semiconductor perspective in here. What else? Shopify, individual online stores. Let's see if they have any commentary on the state of the economy there. If we take a look at the trade desk, that would be similar in the same vein as AppLovin. Coinbase is going to be an interesting one. And I think that's it for me. SoundHound could be just an honorable mention as a pure play AI, right? SoundHound really a little bit more in the AI world than when perhaps they first started. So that is what I've got on the calendar in terms of interesting watches. If you said, Matt, you can only watch 3, it would be Palantir, it would be AMD, and it would certainly be Uber. That's what I've got on the calendar. Let's jump back on over to the charts and let's take a look at what's going on in some of our specialized charts, deeper technical look. IEI, generally bonds relative to themselves, continuing to signal that the market's still somewhat concerned about inflation. That's this one down here remaining elevated, while these are in a downtrend. So we'll carry that narrative forward, but for now, I think it's about what Jerome Powell says on Wednesday. Looking into credit spreads, we saw an uptick in volatility earlier on in the week, even as the market remained sideways, and then the rollover into the end of week is a little bit more telling. I would like to see if the LQD credit spread as a proxy could make a lower low here again. That would be a little bit more meaningful. Notice just on a relative basis, let's do this, here and here, you're much lower on the SHY-HYG one. Let's jump into junk bonds in isolation here. They are suggesting a negative divergence, a bearish negative divergence versus what we have here. So one more time, being mindful of your trade location. It's not that, oh my God, the HYG is in this huge downtrend, we can't possibly be long the S&P. It's just maybe we think twice about buying the highest high, and we would much prefer a higher low pullback as this remains divergent. Let's take a look at the LQD. In isolation here, same story, right? You can see the bearish negative divergence versus the ES S&P making a higher high. Let's jump into, we talked about Bitcoin, but let's go full screen here. Again, a risk on asset. There's no other way to describe it. We're over that 92,000. That is bullish for the markets. Let's take a look at total breadth. Big uptick here, big thrust this week. Huge push higher out of the 50 SMA measure, which is right here. More than 50% of companies have now recovered the 50 SMA in the S&P 500. You can see here, 200 SMA is well on its way. It would be best if that could get up and over the 50% mark as well. New highs versus lows is going positive as a bullish indication, so breadth is confirming the move in the upward direction. As we look at the RSP, it's at a big battleground here. Once again, trade location tells us if the RSP pulls back, it's not the end of the world from a trend point of view on the equal weight, but we might not want to be long here, right, in the S&P weighted as traders. So be mindful of that. Let's jump into the QQQE. Same story. I would say that the NASDAQ's a little bit different in terms of breadth, noting that you're sort of just in a similar situation. There's not much of a divergence between where you are on the two. So if anything, that just reaffirms that the equal weight is doing what it should do. I did want to point out that transports did start to see a little bit of a breakout there on that Friday session as bonds moved lower. I'd be interested to see if this retraces back into these equal highs here for the Dow theory. Not overly concerned with it, but just relative to the transports, we know they really reported pretty rough, or the transport charts have looked pretty rough. You know, CSX, Union Pacific, UPS, FedEx, those guys really did not give us much confidence as a bellwether for the economy. So watching the DJT. If we look at the VIX, it is lower, most meaningfully on that Friday session as the market sort of continued to grind in the upward direction there. Generally speaking, I think that volatility has made substantial strides here, even as we look at the VVIX. I mean, yeah, some upper wicks in here, whatever, but still staying and closing the week underneath that 103 handle is a little bit more impressive and reaffirming on the long side. As we look at the volatility futures, this is what we care most about. Notice that the contango attempt is continuing to happen here. This is 9 versus 30-day VIX. The actual VIX futures have not quite done it yet. Let's go full screen there just for a second, and let's move this around a bit. So you could see as the week wears on, we're getting closer and closer to the contango, especially into the end of the week, but we do want to see this thick white line move over the zero mark. The closest thing we have to a contango is the furthest out, and you can actually see this over on the trade tab. If we go /VX, you could see here on this, notice that this is the farthest out that chart was tracking at least, but you could start to see how from here to here, there's actually more risk in the future, and then it promptly flattens out again, and that's why we still have some work to do. So ideally, this curve starts to look like that, and I would think that we're probably closer rather than further at this point, noting the progress that's been made off of these lows back in the upward direction, very close to the zero line. Just need those final little bits of volatility to fall out of the market. And you're starting to see it, honestly, in the one-day VIX. We talked about this last weekend. Remember that the S&P 0 DTE phenomenon means that this is probably the most important measure of VIX as of right now. You're starting to move underneath that 2145. Remember back here, it was just acting as a support shelf. Now that we're underneath, that is definitely a step in the right direction for a little bit more confidence to come back into the market, especially on the shorter end, like literally this 0 DTE options madness. Let's check in on the skew just because we haven't done that in a little while, and it is somewhat important. We're not at the throwing in of the towel point yet. That would be at 113. Yet to be determined. Let's jump on into our core list of companies. Let's move this along, and then I've got 3 trade ideas for you, and we'll be on our way. NVIDIA, right? We talked about the SMH. We talked about how semiconductors look good here. NVIDIA can either do two things. It can either break out, over the 90-day pause high, which would be a reasonable breakout. We're coming in after higher lows, higher lows, higher lows. If you really want to stretch it, you could say that this is an inverted head and shoulders. You could say that this trend line has been gapped up and over, and the next step is breaking the horizontal neckline, right? So over 114.25 looks pretty compelling to me to rotate through some thin structure from back here towards the top end of this zone. That's 118.75 to 121, the equal highs from back here. If NVIDIA pulls back, it's not the end of the world for a gap fill reversal, trading back into the equal high and then looking for the Brigade bolt back over the level at 114.25 as we walk forward. Earnings are always much further out on NVIDIA, so not a concern as of right now. If this reverses through the gap, and does not hold gap fill reversal, let's say it looks like that, I would still be open-minded to an equal low hold at this 104.75. Just noting that the gap down on the, Wednesday session, GDP numbers, on Wednesday's session, the gap down right to the level, it held. Right? It held pretty firmly. If sellers were going to make a stand, that should have been when they did it. This would just start to turn into a balance, and then over time, balance rules would be in play. So NVIDIA is either a long breakout that looks like this or a gap fill reversal as the primary idea, developing into the same thing. If it does make the equal low, I'd be a little bit more neutral. Maybe you trade to the midpoint of the range, mean reversion, but I'd be neutral in there. Let's take a look at Microsoft. Microsoft is a wait and see. Just the nature of the gap up from the Wednesday earnings announcement, huge, obviously, really strong cloud numbers, Azure. So 395.50 is the full gap close. I would not think we're going there anytime soon. The recapture of the 403.25 as I zoom out, the bottom end of this weekly balance, strikes me as really meaningful. So now all the investors who are like holding on and saying like, oh, this is kind of sucky, and then like boom, they've been rewarded. They get a big sigh of relief. So I would not be thinking about Microsoft as a huge short here unless it starts to break back down underneath 403.25. It's a really dim level on the screen. I'm sure you might not even be able to see it, but it's right here. It's the bottom end of this range, right? In the meantime, again, it's a wait and see. There's really not much to do or say in terms of chart structure up here. Maybe this is developed as a little bit of a balance range. If we look at the hourly chart for a little bit more insight, if you're over the 432.50, you're at least over that Thursday afternoon lower high, consolidation here is maybe healthy, and then Brigade bolts over 440.25. Just becomes tough to manage your risk until new structure actually builds out. So I'll be watching for that, but it's really not a top priority. Any consolidation in here is just exactly that. I would not making any big bold bets yet based on just 2 days worth of range. Let's take a look at Apple and see what's going on. Daily timescale. This is where there's a little bit of disappointment. Like Microsoft, really strong numbers, and then Meta, really strong numbers, CapEx reaffirming, and Apple, Amazon on Thursday after the close, kind of just a flop, right? Apple is just totally botching the AI rollout and obviously citing devices and tariff turmoil there. Not a shock to see it lower under the 206.50. If you get consolidation back in the range, I think that the gap trade is clearly what we're still watching for in the upward direction. That doesn't really change, right? It's this consolidation here, Brigade bolt above, if it's going to happen, or if you just get consolidation that breaks back down like this, or if you just consolidate here. I really don't like Apple as a primary contender for like trades to take or things to do. It's just this grind in the upward direction wasn't really fruitful intraday. I think it's either a gap close trade overhead or put it on the back burner. I hate to say it, but that's the name of the game there for Apple. Technical chart, leaves a bit to be desired. Amazon on earnings as well. I mean, the only argument here is that it made the sympathy move on Thursday's open with Meta and Microsoft, and then it just kind of went sideways on the Friday session. On its individual earnings, you're still underneath a pretty big threat. There's not nearly as much of a gap up in the upward direction. So I would take it one step at a time here out of Amazon and probably think that, consolidation here maybe gets us Brigade bolts for small steps in the upward direction into this range. All the, when I say all, I'm really just referring to Microsoft. Huge gap up there got us away from a lot of consolidation and chop that we would have needed to battle back up through. If we take a look at the hourly time scale here, there's your consolidation, right? A range double, maybe it gets you to your next target, but you're talking about like these incremental targets here. If you're more than just a day trader, someone who's swing trading or whatnot, maybe you look for this and your entire move is from $192.25 to $200.25. But day traders, even small swing traders, like day or two swing traders, which I don't know how you could be in this current market environment, bless you, but over 192.25, I mean, just walk these mild targets up, 194.75, 197.25, coming from what we can clearly see back here. I think things kind of open up over that into this previous zone, $200.25, as we've mentioned. So that is Nancy. If it's going to break down, I would need to see it through the gap and here underneath 183.50 before I really put my bear hat back on and say, okay, it's the end of the world. The only time, I suppose, that this would be bearish would be a look above and fail. So some sort of failure pattern up here because the trend is trying to flip to up. We're still inside of the balance. Again, we do have that threat off to our left on the daily time scale. So if you're looking for a short here, maybe you'd probably need the broad market to be pulling back at the same time, right? So look above and fail, that starts to get a little bit weak. If you could manage risk here for the pullback to close the gap or something, I wouldn't say that that's wrong necessarily, but you are fighting the very short-term trend that's happening here. Let's jump into Google. Google looks okay. Let's go to the hourly because I think the hourly helps Google's case a little bit more so. Consolidation over 163. Let's zoom in even further. 163 right here. Consolidation holds above. I would just still be thinking about the thin structure retracement as a trade into 166.35. I would also be thinking if this breaks 163, I would look for the long off of 161.50 ultimately for this risk reward here. That's what a higher time frame idea would emerge, right? Because you've pulled back from the highest high, you've set a higher low relative to this. That would also be a higher low here at 161.50. So I'd try to exploit that as the first idea. It would also be a hold of the daily 50. If it's going to be a short out of Google, I don't know that I even like it underneath 161.50. Just based on the nature of the trend here, based on the way that the reversal is over the 90-day pause high, I would think that for me at least, I'd have to be underneath that level, which is 158.75. And at that point, you're shorting into support here at 157. I really don't like the Google short side until if this is going to turn into a double top, then like, fine, we'll call it what it is. When it happens, you would need to be under the neckline 157. Maybe the gap close starts to act as your target. So that's Google. Let's move along to the metaverse, another gapper. Certainly moving over the 90-day pause high. A little interesting, fading off on the Thursday session there underneath the high, but then to recapture on Friday. Now walking forward, I think it's quite clear what needs to happen. Holds the daily 50 and 200 in here. We have the 586 level. If we can consolidate over that, Brigade bullets to the upside probably bring us up to the equal highs here at 635.25. There is a level in the midpoint of that range at 622.75 for day traders to be using as a target. If we do see a reversal, this is a trade I would be open-minded to. I would not feel uncomfortable trying to take a short on Meta if we get some sort of acceptance back below 586 consolidation here. This is a poor low, very, very mechanical. Look at all the equal lows. The opening drive low, 1, 2, 3, 4 lows after the opening drive low, all to the same level, 571. If we get there, I would expect that that level is weak. A break should start to close the gap. I would target these equal highs first at 555.50 and then the full gap close 549.25. Okay, obviously that starts to look like, in hindsight, a little bit of a head and shoulders. Okay, so Meta could go either way, but those are the two ideas I would be thinking about. Tesla, continuing to just break hearts up here near the daily 200 SMA. I think it's clearly signaling that it's got to get up and over that level before this is going to ultimately trigger as a daily double bottom, right? So call this for what it is. It's a bull flag, not the greatest candle on the Friday session, but over something like 93.50, 293.50, gives us the next opportunity to start thinking about this thin structure retracement. I've been talking about this for a while. That's the range I'm really most interested in next, right? That's where the next large trade is going to unfold. You can see Tesla makes a move, and then it sort of just pitters out for a bit. Tesla makes a move, it pitters out for a little bit. That was earnings anticipation, perhaps. Here's a move, pittering out a little bit. The next move, ideally, I'd like to capture some degree of the range between these two key levels here, 303 up to about 326.50. If it's going to be bearish, maybe underneath the 90-day pause high, underneath the lows of the flag range, cause a pullback. I'd still keep an open mind for a daily higher low, lows, equal lows, higher lows, potentially at 260. Moving along to JP Morgan. JPM, equal highs have been made. We talked about financials looking good. Again, pullback ideas, all equal highs over the top end of the range. Range doubling target has been hit. Measured move has been hit. Consolidation, pullback seems fine. If it does just blast straight up through this, just walk up your targets. In theory, there's not much structure back here. I'd be looking for 266 in the grand scheme of things. JP Morgan's honestly been one of these names that just exists on the core list to keep us aware of what financials are doing. So probably worth removing maybe some of the intraday trader levels that maybe are a bit less meaningful in these analyses. Let's jump into Netflix. Netflix new all-time highs, just another bullish indication for the broad market. Once again, in a recession, will people be canceling their Netflix subscriptions? Who knows? Probably not, right? So all of a sudden you get that weird inversion of, instead of healthcare, it's going to be something like Netflix. I don't know. It's a bit of a stretch to think that way, but you get my jest on this Saturday morning. Let's move into our 3 additional trade ideas. Obviously for Netflix, it's just up and away. There's not much to really comment on here. The best pullback would be something that retests all the way here for a daily high or low. That's 1102.25. Jumping into some trade ideas, none of them are tech related. One of them kind of is, but let's go LMT. Lockheed Martin's up first. I love if the broad market is going to pull back. Look at the bearish engulfer out of Lockheed on the Friday session. Notice that we had this little range here. We gapped up and over the range, no hold, no break of this high, nothing. We've actually closed underneath after making a lower low. So now that you understand the context here of this as a double bottom sort of failing up and over the gap up over the neckline, let's go down to the hourly. You could see that the lower high here certainly could suggest Brigade Bolt, target daily 50 SMA. So if the broad market is weak, I would love to see something along these lines for a short on LMT Lockheed Martin. Be curious to see also if government contracts get buttoned up or something along those lines. There's a headline, right? Let's go PANW, Palo Alto on the next trade idea. This is a short trade idea as well for just a very simple range rotation, right? If this is a 2-day balance range, we gapped up and failed on Thursday. Friday gapped up, but it was unable to hold strong like the broad market was. We closed back inside of Thursday's range and at the top end of the 2-day balance range. As we take a look at the hourly time scale, it's just a flush point, right? Draw in your little descending triangle, call it a bouncy ball. It doesn't matter what you want to call it. Lower high here, range rotation. If the broad market is bearish, there should be a decent short opportunity in Palo Alto below 187.50 to target the range lows at 183. If you're over 187.50 and just balancing, I would not be forcing a short. Let's move into the final trade idea here, which is on target. Target, and there it is. Look at that. I hardly ever draw in trend lines, but this is so precise, it felt wrong to not draw it in. Look at this balance range down here. Obviously, I'm still a proponent for needing to break the horizontal level. I would want to see something over 98 to close this gap. This is from the tariff turmoil up towards 103.85, which is matching beautifully with the daily 50 SMA. If we can get there, it's a great spot for sellers to maybe step up. So this is a trade from point A to point B. We are clearly in a very aggressive daily downtrend here. A lot of people probably would just call this a bear pennant, which is why this setup can go both ways. If you are a bear and you're like, nope, this is it, it's game over, you got an inverted hammer on the Friday session. It would not technically be incorrect. I'm going to get pretty nuanced here, so bear with me. So something underneath Friday's low at 96.75 gives shorts an entry to target the trend line. That gives you about a 1-to-1 risk-reward ratio if you put a stop over the high of day there. If you're a bit more aggressive and you're like, no way, Target's going to get absolutely obliterated on all this tariff stuff, the China deal's not coming, it's all fake news. If that's your mindset and price agrees, you could probably start targeting, I don't know about the full max fear lows at 88, but it wouldn't be unreasonable to maybe start thinking about a retest of this zone right around in here at 92, in which case, risk, reward, something along those lines, right? Remember, the first thought is if we open inside of range on Monday, this is my first thought. The broad market is bullish. We have a gap to close overhead, and if there are any positive developments over the weekend in terms of tariffs, specifically on manufacturing, China goods, Southeast Asia goods, right? That's probably going to cause some upside here out of Target, alleviation on the tariff front. So that's the final trade idea for you. It could go either way. You know where my head is in terms of which way it leans, and I will leave you on that note. That is it. That's what we've got for this weekend's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section. Am I crazy for saying that Jerome Powell might have a surprise rate cut up his sleeve for us on Wednesday, or at least the odds should be a little bit higher than they are currently? Love to know your take on that. As always, we will be live on Monday morning at 8 o'clock Eastern time for another episode of our pre-market prep. We'll build a game plan for the session, and keep in mind we'll have a special episode on Wednesday as well to stream Jerome Powell live. We'll see what he has for us, whether or not he lands more dovish or more hawkish for the market on that session. With that said, have a green trading week, and I will see you in the next one.